A senior economist joins us to talk about the state of today's housing market. Non-QM lenders shutting down, more vacation homes bought in high disaster risk areas, and fourth-party oversight. From PropLogix, these are your top 4 stories in real estate this week. So much has been changing in the market when it comes to inventory, pricing, and volume. It only makes sense that in order to help us all understand the market today, we bring in an economist, specifically 𝗙𝗂𝗏𝗏𝗀𝗏, who is a senior economist and director of forecasting over at NAR, or the National Association of Realtors. Among many things, 𝗙𝗂𝗏 focuses on regional and local market trends, including the effects of changing demographic and migration patterns to forecast housing activity. Here's a clip of that interview. 𝗙𝗂𝗏, welcome to 4 Stories.
Hi, Jordan. Thank you for having me here today.
So excited to have you. 𝗙𝗂𝗏, is this the craziest market you've ever forecasted for or been through?
Actually, since 2020, and specifically after May 2020, the era of COVID-19, the world of real estate has seen a massive shift. The US housing market was unpredictable, to say the least. During 2021, sellers received multiple offers on their houses as soon as they were listed, and their houses ended up in the middle of bidding wars with multiple buyers, and sellers often close at double-digit percentages over initial asking prices. And so 2021 was the best year in the last 15 years, since 2006. Home purchases rose in an abnormal way, although home prices were rising, eroding affordability. And we expected that, but not at the pace that we at the level that we saw that. So and the main reason is due to low mortgage rates. Mortgage rates were very low, reaching record lows. So many buyers wanted to benefit from these low mortgage rates. In the meantime, inventory also reached record lows. Thus, low inventory and mortgage rates resulted to multiple offers. As for now, the market is becoming relatively more normal, and this is what we want to see, and more normal, more predictable, healthier real estate market. Mortgage rates have dramatically increased since the beginning of the year, about 2.5 percentage points. Thus, due to higher mortgage rates, we actually expecting now not to see a slowdown in the housing market, and this is what we see already. Home sales have dropped for the last 4 months. So this is something we expected, and we also expect to continue to have this drop in home buying activity.
Right now, affordability is on many people's minds, especially first-time home buyers. What would you consider to be the critical factors in shifting the market in those buyers' favor?
Indeed, compared to the beginning of the year, buyers need to spend about $800 extra every month for the median price home. So in areas with very expensive areas, it exceeds $1,500 or more. So as a result, the qualifying income for the median price home has increased to above $100,000 from $70,000. So while there isn't any set income requirement to buy a home, the qualifying income shows how much money someone needs to earn if he wants to spend for principal and interest about 25% of the income. And what we see is that many buyers no longer earn the qualifying income for the median price home. So they're out of the market. So when inventory, to answer the question, so when inventory is low and demand is high, we have what we call a seller's market. And when demand is low and inventory is high, we have a buyer's market. Thus, what we need to have in order to shift the market is more homes to be available for sale. And actually, this is what's happening. This is what we see. Since the beginning of the year, inventory has increased about 35%, while it's typical to have more inventory in the spring and summer months. Inventory is rising faster than the average level, the historical level. And according to our data, it shows that inventory, for example, rose 25% during April and May, compared to 8%, which is like the pre-pandemic average level growth for the same time frame. However, we should also have in mind that we are still missing many homes. And to give you an idea, in a balanced market, we need to have about 2 million homes available for sale. However, we currently have just a little over 1 million. So although inventory is rising, it's still low. So this is what we have to have in mind.
Right now, we're also seeing record high prices. You kind of spoke about that a little bit. And obviously, the Fed continues to raise interest rates in order to combat the rising inflation, including the housing market. But specifically in the housing market, when should people start seeing costs start coming down as a result of those rates?
Yeah, so unfortunately, we expect affordability to decline even further, in the following months. Both home prices and mortgage rates will continue to rise, increasing the home buying cost. However, there is a bright side, in the story. So the good news is that we expect both home prices and rates to rise at a slower pace. First of all, the Fed will take more rate hikes in order to slow inflation. Although the Fed already raised its short-term interest rates 3 times, inflation still runs at 40-year high. And we have mentioned multiple times, that it will take several months for the Fed to slow inflation. And of course, the war in Ukraine doesn't help. It makes Fed's mission even more difficult. So as the Fed will raise interest rates in the following months, mortgage rates will also increase. However, it seems that the upcoming rate hikes will likely have a smaller impact on mortgage rates. And for example, when the Federal Reserve rates its short-term interest rates in March by 25 basis points, mortgage rates surged about 80 basis points in the next following 3 weeks. As a result, the 30-year fixed mortgage rate rose to about 3.9, from 3.9 to 4.7% by the end of March. However, when the Federal Reserve raised its interest rates again more aggressively in May, mortgage rates increased by less than 20 basis points, and then rates fell to 5.1% by the end of May. Thus, the data shows that the effect of the Fed's rate hike on mortgage rates was smaller in May than in March, and this is the trend that we see from the last rate hike that we had. So it seems in June. So it seems that mortgage rates have already priced in some of the effects of the upcoming Fed rate hike. So although mortgage rates will continue to rise, I don't expect to see the same sharp increases that the market experienced back in March and April. So it's possible rates to surpass 6% in July and reach about 6.5% by the year end. And as for prices, which is the other factor that increases the borrowing cost, we also expect to continue to rise, but at a slower pace. And to give you an idea, home prices will likely rise about 8% in 2022. So unfortunately, we don't see in the near future to have some easing the affordability. No, we expect to decline even further.
Yeah, and this is a question that people ask me about, but I tell them I'm not an economist. So, but since I'm talking to an economist, how comfortable are you in making predictions for the housing market over the course of the next 3 to 6 months?
Yeah, no one can tell what it will happen for sure in the next 6 months. However, after looking at the data, we can tell what's more possible to happen. So for the second half of the year, for the third and fourth quarter of 2022, we expect home sales to drop about 14% on average, and home prices to rise about 7% on average. And as for mortgage rates, as I mentioned already, that the 30-year fixed mortgage rate is possible to reach about 6.5% by the year end. So these are some predictions that we have. Of course, this changes sometimes, but this is, and now I think it's we have less surprises. So I think it can make like our work like easier.
Well, Nadia, I really appreciate you jumping on this call with me and going through all of these different things going on in the market. I think a lot of people have a lot of questions. I think we answered a lot of them. So thanks for coming on the show. Hope to have you again maybe in the future.
Sure. Yeah. Thank you.
Would you buy a vacation home in a high disaster risk area? I ask because over the past 2 years, nearly 45% of vacation homes were bought in areas susceptible to flooding and other natural disasters like storm, heat, fire, and drought. Vacation home sales were also down below pre-pandemic levels for the first time in 24 months. You commonly hear about third-party oversight, but now the Federal Housing Finance Agency is looking to beef up its oversight of fourth parties that do business with businesses that do business with Fannie and Freddie Mac. That makes sense, right? In some cases, those third parties must receive approval from the enterprises to engage in businesses with subcontractors. There's a growing concern that the enterprises and their contractors are vulnerable to increasing cybersecurity risks. That's it for 4 Stories. Real estate news doesn't end here. Follow PropLogic on social media. Subscribe to the show on any of your favorite podcast platforms. Watch behind-the-scenes footage on YouTube. And let us know what you think about the show by sending us an email at 4.stories@proplogics.com. I'll see you next week.